Getting a mortgage pre-approval can give you an advantage while house hunting, and it's almost a rite of passage as you go through the process of buying a home. Pre-approval is based on your financial profile, including your income, how much you have in bank and investment accounts, and also your debts. Lenders perform a hard credit inquiry as part of your application as well. With a pre-approval, sellers and their realtors know you're serious about buying a home, and they know you can afford it. On top of that, getting pre-approved gives you an idea of how much home you can afford. You can see how much money the lender will give you, figure out a down payment, and know if the houses you are considering are practical. It saves time during house hunting to immediately eliminate homes out of your price range. The steps for getting pre-approved for a mortgage include sharing detailed financial information about your income and debt, and undergoing a credit check. To get pre-approved for a mortgage, you'll need to supply documentation about your income, assets, and debts. These documents include pay stubs and W-2s, as well as proof of other income sources, and any accounts you own, including retirement savings. You'll need to share this information with any lender you're applying for a pre-approval with. So it's best to have it all organized before you start seeking offers. In addition to providing documentation, you also have to agree to a credit check. It's wise to check your credit report before your lender does, in case there are errors that could impact not only whether you get pre-approved, but also your ability to get the best mortgage rate. You're entitled to a free copy from each of the major credit bureaus once every 12 months, which can be obtained at annualcreditreport.com. Know that when lenders check your credit, they perform a hard inquiry, which can impact your credit score. Lenders look at your credit report and history to assess your credit utilization, or the amount of credit you're using relative to your total credit limit. The lower your credit utilization is, the better your chances of getting pre-approved. Once lenders assess your credit and financial profile, they'll make a determination as to whether you're pre-approved for a mortgage, and for what amount. If you're pre-approved, you'll be issued a pre-approval letter stating this information. Many lenders prefer to use the 28/36 qualifying ratio to figure out what monthly payment you can afford. In general, they like to see a mortgage payment taking up no more than 28% of your gross monthly income, and your total debt payments accounting for no more than 36% of your gross monthly income. Note that if you're getting a conventional mortgage, you usually need a credit score of at least 620 to qualify. You might be able to get a mortgage pre-approval with a lower score, and there are programs like FHA loans that allow lower scores. The higher your score, however, the lower your interest rate. The most time-consuming part of applying for a mortgage or getting pre-approved is all the documentation you have to provide. So, it often helps to get as much paperwork prepared ahead of time, so you're not scrambling when your lender starts asking you for your documents. Follow this checklist to help yourself get ready. Your current financial profile is a major part of getting pre-approved for a loan, so your lender wants to see that you have reliable, predictable income. These will help verify your employment history, and show the lender a longer-term track record of your income. Lenders like to make sure that all your money is accounted for, so they check your bank statements to see that there aren't any major unexplained deposits or withdrawals that could affect your loan. Returns in your investments can count as income, and lenders need to know about all your sources of money, not just your day job. Lenders need to make sure they know who they're giving their money to, so they'll want to verify your identity, and that you're a U.S. citizen. Foreign nationals can get financing, but it's much more complicated. Those who are self-employed might also need to include information from business accounts, and undergo an income audit. This might include asking an accountant to verify that your income is stable, by speaking with customers, reviewing business records, and taking other steps. Find out from your lender what's required when you're self-employed. It usually takes up to a few days to receive your mortgage pre-approval. If you have to wait for an income audit, it can take a bit longer, usually a couple of weeks. If you have everything in order, and your credit looks good, it's possible to get pre-approval for a home loan within one business day in some cases. It's important to understand the difference between pre-approval and pre-qualification. Pre-qualification is an indication of what you likely qualify for based on the information you give, and the results of a less invasive credit check. With a pre-qualification, you're often subject to a soft credit inquiry, just so the lender can get a feel for your situation. The lender often relies on your own representation of your financial situation, rather than requiring documentation. While a pre-qualification can be useful when shopping around, and comparing potential loan terms, it's not usually taken seriously by sellers and real estate agents. On the other hand, a mortgage pre-approval is a more rigorous process. You provide documentation to back up your claims, and the lender reviews your credit report in more depth, to get a sense of your debt-to-income ratio and other information, to help them make a determination. Because a pre-approval is backed up with data, it's accepted as proof that you can afford the home you're looking at, and the lender will fund your loan. Whether you're buying your first home, or you're a seasoned house hunter, getting a mortgage pre-approval is a smart move if you want to remain competitive as a homebuyer. Your mortgage pre-approval shows that a lender is ready to lend you a certain amount of money, making an offer you put on a home a more serious one. Please share this video if you found it helpful. And also don't forget to subscribe for more tips and tutorials. See you on the next video. Thank you.